Welcome to my channel. In this video, I'm going to be comparing compound growth versus linear growth. Have you ever wondered between these two, which is better? Watch this video to the very end, as I am going to be considering every segment in this comparison, step by step. I'm going to be taking 8 steps to explain and outline the differences between these two, making you see clearly which is the best at the end of it. This video will show you why the rich love compounding. Two people start with exactly $1,000. Person A gain $20,000 every year, whereas person B earns 20% per year and reinvest it. Then after 20 years, we'll see in this video who becomes richer. I bet you the answer may shock you. Now, here are the steps I'm going to follow in explaining all of this. In step 1, I'm going to take you through understanding linear growth. Then in step 2, we will calculate linear growth itself. Then that will take us to step 3, which is understanding compound growth. And at step 4 will be early compounding years. We'll be considering the early compounding years as at step 4. And then at step 5, I'll take a head-to-head comparison between linear growth and compounding growth. I'll be showing you with a table for a simpler understanding. Then I'll draw a graph to represent that in step 6, and then in 7 I will show you real-world financial application of what you are studying so far in this video, and then leave you with the lesson in comparing linear growth with compound growth. In understanding linear growth, take it to heart that linear growth adds the same amount every year. The same amount it adds for the first year will it repeat in the second year, and continues with it till the end of that business investment. The growth in linear pattern is constant. The amount of interest coming in is constant. You can see on your screen the formula for linear growth. Y is equal to mx plus b, where m is equal to yearly increase and x equals the time, whereas b is the starting amount with which that financial involvement was started. Take for example, starting amount is equal to 100,000. Annual increase is equal to $20,000. Linear growth is like climbing stairs. Every step is the same size. Your money grows steadily, but not faster. And with this, we'll move to calculating the linear growth itself using a table for a clearer explanation. Okay, we'll represent the years and amounts in this table. Say in year 0, we have the initial amount at $100,000, and in year 1 it grows an addition of $20,000, making it $120,000. Then in the second year it became $140,000, and in the third year it grew to $160,000. Fourth year $180,000. The fifth year it became $200,000. 10th year is now becoming $300,000, and then say in the 20th year, using this formula I showed you, it will become $500,000. If you check through the table clearly or paying very close attention, you will notice that it's only increased by $20,000 per annum. So after 20 years, the account reaches $5,000. That's 5 times the starting amount, which was $100,000. So not bad. But then let's compare it to compounding. Hence, understanding compound growth becomes our next step of focus, guys. Compound growth grows by a percentage, unlike the linear growth. Growth ends more growth in compound growth. Here is the formula for compound growth. A is equal to P bracket 1 plus R exponential T, where P is equal to the starting amount, R is equal to growth rate, whereas T is equal to time, to be calculated in months. Compound growth is different. Each year's gain becomes part of the next year's investment, making your money begin working for itself, unlike the linear growth. Applying this formula, let's look at this example quickly, where starting amount can be taken as $100,000, and then annual growth rate, which is the arrow, becoming 20,000 or 20% per annum. Substituting into this formula, F equal to A bracket 1 times arrow exponent of T will give us that A is equal to 100,000 bracket 1 times 20% bracket close exponent 1 month or 1 year, as the case may be. Therefore, in our early compounding years, considering this example just given now and substituting into this formula, F equal to A equal to 1 times R in brackets and exponent of T. Here, let's consider T to be 1 year per annum. In the year 100,000 times 1 times 20% will give us 100,000 times 1.20, which is $120,000. In the year 2, $120,000, which is now our amount, we multiply 1.20, which is 1 times 20%, giving us $144,000. Now come to year 3, where we now have $144,000, which will still be multiplied by same rate in percentage per annum, 1.20, to give us $172,800. Notice that the increase keeps getting larger. The growth itself is growing. Now let's go into head-to-head comparison between linear growth and compound growth, guys. And if you're yet to subscribe or follow me in all my social media handles, please do so as to get notification on when next I post a new video on financial mathematics education, finance education, such as this, to better your financial calculations and increase or boost wealth generation from your end. Now from the table, you can see from year 0, the linear growth is 100,000, while the compound growth is 100,000, meaning they start from the same start points. Then in the first year, which is year 1. Linear growth becomes 120,000, where compound growth attain same. But getting to the second year, year 2, linear growth becomes 140,000, whereas compound growth increased a little bit further to $144,000. Year 3, linear growth is 160,000, compound growth is $172,800. Year 4, linear growth is 180,000, is increasing on a steady basis of $20,000. Compound growth is $207,360. In the 5th year, linear growth becomes 200,000, where compound growth attains $248,832. Jump to the 10th year, where you can see linear growth extending to $300,000. Good. But on compounding growth, you can see $617,174, which is twice double of linear growth. Then, the 20th year, linear growth attained is $500,000, whereas compound growth is way beyond $1.3 million. Bro, here is a graph of linear growth versus compound growth. The curve gets steeper and steeper. Linear growth moves in a straight line, whereas compound growth starts slowly, then explodes upward. Time is the fuel behind compounding. Now let's go to real world financial application of this comparison, guys. Linear growth examples. These are fixed annual salary raises, fixed monthly savings, consistent bonuses. And then compound growth examples are stock market investing, index funds, retirement accounts, reinvested dividends. Most people focus on earning more, while people focus on compounding more. The goal is not just to make money. The goal is to make money make money. Now, pay attention for the lesson that can be derived from these comparisons, guys. First of all, take this for a bonus. The wealth equation. This is money plus time plus compound growth equal to wealth. That having been said, the greatest financial asset isn't money, it's time. The earlier you start compounding, the bigger the advantage. Which would you choose? Between a gain of $20,000 every year, or B, an earning of 20% annually and reinvesting, earning 20% annually and reinvesting it. Whether A or B, the initial amount is the same. Take it to be $100,000. Leave your answer in the comment section. Guys, linear growth can make you comfortable, but compound growth makes you wealthy.